All right, before we jump in, just the usual heads up. This is all for educational purposes, and it is absolutely not financial advice. You've always got to do your own research.
So today, we're doing a deep dive. We're going to completely ignore the day-to-day price noise, the charts, all of that. Instead, we're going to focus on the engine humming underneath it all, the thing that's quietly generated over $73,000. Let's get into it. Okay, here's our game plan. We'll start by asking the right question. Then we'll break down how this yield engine actually works piece by piece. We'll look at the proof, compare it to other DeFi models, talk about the approaching crossover point, and finally wrap it all up with what I call the mining rig mindset.
All right, first things first. To really understand what's going on with PLAZM, you've got to ask the right question. It's so easy to get caught up in the price, but that's just noise. The real story, the signal, is something else entirely.
You know, the question almost everyone asks is, what's the price today? But honestly, that's the wrong question. It's just a snapshot in time, right? The real question, the one that actually tells you if this thing is healthy and sustainable, is this. How much actual yield is the protocol generating? And the answer to that question? $73,169. And listen, this isn't some made-up number, it's not a projection, and it's definitely not from printing more tokens. This is real, hard revenue generated from trading fees over the last 130 days. And this number right here is the key to everything. Okay, so where does that 73 grand actually come from? And more importantly, how does it end up defending the price? Let's trace it step by step. So it all starts with those 8,227 bonds. The easiest way to think about them is they're out there on the front lines collecting tiny little fees from all the trading activity on the exchanges. Then those fees get collected or harvested. The protocol splits up that revenue. And then, and this is the cool part, it deploys that money as defense, which is really just a fancy way of saying it takes that cash and buys its own token, PLAZM, right off the market. Now look at this breakdown. This is where it gets really powerful. A whopping 65% of that yield is used to buy and burn PLAZM. I mean, gone forever. Another 28% is used to buy PLAZM and build up the protocol's own liquidity. So when you add it all up, you're looking at 93%, 93 of every single dollar earned going directly back into supporting the token's value. And hey, this isn't just a plan on a whiteboard. We're talking about real action. So far, more than $57,000 in actual stablecoins have been used to buy up PLAZM. The result? Over 1.2 million tokens have been permanently wiped from existence. That's 18% of the total supply gone for good, all paid for by outside revenue. Okay, so that's the how, but does it actually work in the real world? Well, the proof is in the pudding, right? Let's look at the hard numbers from the last 130 days. This chart is, well, it's pretty eye-opening. What you're seeing right now, this roughly $500,000 a year pace, that's happening in a bear market. It's the worst-case scenario. Now look at what happens when things get back to normal or even enter a bull market. We're talking double, maybe even triple the yield. And get this, it's from the exact same set of bonds. So what we're seeing right now, that's not the peak. That is the absolute floor. And the machine itself is getting bigger. It's not static. In just the last 46 days, the number of bonds has grown by almost 38%. That's like adding a whole bunch more mining rigs to your farm. And what do more rigs do? They generate more revenue. It's that simple. And that growth wasn't just for show. It translated directly into cash. Almost $20,000 in new revenue in just that 46-day window. What's absolutely wild is that this was happening during a really tough period for the protocol. I mean, sentiment was down, there was a lot of sell pressure, and the engine just didn't care. It just kept chugging along, producing yield. You know, that resilience really highlights the key difference here. It's the core strategic advantage that makes this model so different from, well, pretty much everything else in DeFi. Think about it like this. On one side, you've got your typical inflationary DeFi project. How do they pay rewards? They just print more tokens out of thin air. It's a death spiral, a declining spiral that always ends the same way. But on the other side, you have this model. It's a perpetual loop. It's funded by real fees. It doesn't need to print anything to survive. In fact, it does the exact opposite. It shrinks the supply. Let's just let that sink in for a second, because this is probably the most important takeaway of this whole thing. This engine, it's permanent. A bond that was created on the very first day is still out there, right now, generating yield, and it will still be generating yield on day 1,000. It doesn't need new users, it doesn't need new money, it just works. So, because this engine is so persistent, it leads us to this really interesting, almost inevitable event on the horizon. It's called the crossover point. And that's the moment when this yield engine basically takes over and becomes the biggest player in its own market. Okay, so let's look at where we are right now. The engine is generating about $1,300 a day in pure buy pressure. Right now, that's enough to absorb about 22% of the potential selling that comes from token releases. So yeah, there's a gap. But here's the thing. That gap is closing. And it's closing because of two big forces that are moving towards each other, like trains on a track.
First, force number one, the daily token releases are about to fall off a cliff. We're talking way less potential sell pressure. At the same time, force number two, the yield from the engine, that automatic buy pressure, is only getting stronger. So you have selling going down and buying going up. You don't have to be a genius to see what happens next.
So this all leads to the big question, right? When does it happen? When does the yield engine officially become the dominant force in the market? Because the moment that automatic daily buying becomes stronger than any potential selling, everything changes. The whole system flips to being net positive, driven by its own unstoppable revenue. So how should you think about all this? What's the big takeaway? Well, it really requires a totally different mindset. You have to stop thinking like just a token holder and start thinking like an owner of a business that prints cash. And that's what we call the mining rig mindset. It's simple. You just forget about the daily price. It's a distraction. Instead, you focus on the only four numbers that actually matter. The number of bonds, that's your machine's capacity. The total profits, that's its track record. The daily output, that's what it's spitting out today. And the bear market floor, that's its worst case performance. These 8,000 plus bonds, they're your mining rigs. They don't have feelings, they don't care about the news. They just show up to work every single day and produce real yield. So just remember this. The price is a snapshot. The yield engine is the story. And that story is told by these numbers. 8,227 bonds, $73,000 in real yield, $1,400 per day. And that's at bear market rates. You know, the yield engine doesn't need bull markets to work. But when they come, and they always come, the same infrastructure produces 2 to 3 times more. 130 days of proof. And it is just getting started.
And that's a wrap on this deep dive. Thanks for sticking with me. And just one last time, please remember, this is all for educational purposes. It's not financial advice. Never invest more than you're willing to lose, and always do your own homework. Stay safe out there.